All right, good afternoon, everybody. We're joined by Matt Aptman of Everglades Partners. Matt has nearly 20 years' experience raising assets for hedge funds and private placements. Matt has worked as the head of business development and investor relations for Impala Asset Management, a multi billion-dollar hedge fund. While at Impala, he raised substantial capital for the firm's investment offerings and global base of endowments, foundations, pensions, sovereign wealth funds, and family offices. Matt has a very good understanding of where institutional investors are investing. Thanks for joining us, Matt. How's it going?
It's going well. Thanks for having me, Mike.
Yeah. So everybody's interested to hear more about the institutional side of business and just investment flows, and I thought it would be great to have you on because I know you're pretty well connected. So first, I guess start out by telling me a little bit about Everglades.
Sure, that'd be great. So Everglades is a boutique advisory firm, and the way we think about it, we have two businesses really. The first is that we act as an outsourced consultant, helping primarily hedge funds. And what we do is we help them develop a long-term strategy, help them institutionalize their business, and really get ready to raise capital institutionally. So that's the first part of the business, which is really more of a consulting business. The second arm of the business is that we act as a placement agent, raising capital for alternative investment funds. And while the first business is really focused more on hedge funds, we raise capital across the liquidity and the asset class spectrum. So that's hedge funds, real assets, private equity, private debt, and some direct and co-investments as well. And we have a pretty broad reach globally across a number of different investor conduits, but there's certainly pockets where we have deeper relationships, and we try to focus there.
Nice, nice. So why don't you take us through what is an institutional investor and how have they been investing recently and over the past, how has that changed?
Yeah, sure. I'm happy to. So I think the question of what's an institutional investor, you're going to get some nuances from everyone who thinks about it a little bit differently. And I think it's probably helpful to kind of start by defining how we determine an institutional investor. And I think we really group it kind of in two different ways. One is by the type of investor, the conduit, and the second is by the geography. So a pension fund in the US may look very different from a pension fund in Korea. So the conduits that we think about on the institutional side are pensions, and those are both corporate pensions and public pensions. Endowments and foundations, who tend to kind of get grouped similarly, sovereign wealth funds, and insurance companies. I think there's also sort of a first derivative of that, which is consultants that service those clients, and they operate either in an advisory role or in a fully discretionary role. The next piece, which I don't know is necessarily germane to kind of what we're talking about today, is family offices, and we could spend a whole session talking just about that because they range in sort of size, scope, structure, and sophistication. And lastly, fund of funds, which is an area that we're increasingly focusing less on. So the core is pensions, endowments, foundations, sovereign wealth funds, and some insurance. Geographically, being based in the US, we've got the deepest relationships in the US. And I'd say there's probably not a conduit or a sub-geography that we don't cover. And then from there are pockets around the world where we focus on certain types of investors. So in Canada, for example, it tends to be very large pension funds. There are fewer, but they're very sophisticated. In Asia, it breaks down regionally. So in Japan, it tends to be dominated primarily by corporate pensions, but some big public plans as well. Hong Kong is a family office market. China is interesting. It's really been dominated by two sovereign wealth funds, but there are some newer asset management activities there. Singapore, you've got sovereign wealth funds, endowments and foundations, and also some family offices. Korea is pensions. And then if we move to the Middle East, it's really dictated by sovereign wealth funds. lastly, well, I guess second to last, Europe. London and the UK looks very much like the US across all channels, actually, with the exception of endowment and foundations. Switzerland is primarily fund of funds with some pensions. Scandinavia, there's some insurance. And then Latin America is really just family offices. So that's kind of how we think about institutional investors, both by conduit and geography.
Right. And so, how are they investing right now?
It's a good question. I think the way that we like to think about it is sort of on that matrix of conduit and geography. So we see, sort of trends in endowments and foundations in the U.S. or pensions in Canada. But maybe before we dig into that, I think it's important to understand where they are right now is to kind of understand the evolution of how they've been allocating. And if you think I think let's talk specifically about hedge funds. And this started as really a cottage industry in the 70s and 80s, which was reserved mostly for high net worth family office, word of mouth. And in the 90s, you started to see institutional capital flowing in, primarily through fund of funds. And that really kind of continued. The early part of 2000s, institutions started to get up to speed. And then post-crisis, things shifted pretty dramatically. And I think institutions continue to rely less and less on fund of funds, and they've continued to move up the sophistication level. The speed with which that has happened has accelerated. And so in the earlier days, people were investing in hedge funds because they got access to something different. And then it became really just all about performance without understanding the nuances of what's going on underneath and driving that. From there, it shifted towards just differentiation between strategies. And so to come full circle and answer your question now, I think the sophistication level from institutional investors is pretty high. So they're no longer just looking to get access to an asset class, to focus just on performance, but they're really starting to delve deeper and deeper into what are the drivers of performance, what is the how robust and unique is the source of alpha, and they want to invest in an aligned manner with the manager, so it's much more partnership oriented, where they're happy to pay a hedge fund manager for that alpha, but they want to pay for just the alpha. So you're seeing a change in alignment, a change in fee structure, a change in fund structure, where the tables have turned a bit, and the bigger institutions can sort of come to a manager now, regardless of how big they are, and dictate, this is what we want, and this is how we want to access it, and depending on the size of the check, this is how much we're willing to pay for it. So the landscape has changed, and then so maybe with that I'll pause and we can talk about some of this.
Well, it's pretty interesting because you brought up a lot of good points there. And so one is, it seems like 15 years ago there were a lot of fund of funds, and that was a big area where people would invest in. And then, especially in 2008, it seems like a lot after that, a lot of them have washed out. And maybe the part of that has to do with different ways of getting, being able to access hedge funds, whether it be through ETFs or AC funds and a number of things like that. And so it seems like a lot less activity in fund of funds. And at the same time, it seems like there's been a broad underperformance from fund of funds and those sort of strategies, especially when you take a look at the global bull market that we've had since 2008. As we speak, we're literally at all-time highs right now in the U.S. equity markets. How has that played in?
Yeah, I think the fund of fund change is driven by a couple of things. Number one, when times were really good and alpha was easy and abundant, nobody really paid attention to the layer of fees. But investors increasingly started to realize there's this extra layer of fees that they're paying to fund of funds that they don't necessarily have to pay, especially if they're not getting a tremendous amount of value. Two is that by entering into a fund of funds, sure, there are fund of funds that focus on different things, but they're less able to fine tune to what their pension obligations may be, or their volatility targets or liquidity targets. And the last is they weren't really able to customize it. So, I think if you take in the aggregate, fund of funds had a higher level of fees and were less customized, and they also didn't necessarily have as much control. So that paradigm shift has taken place. I'm a little bit surprised by how long that sort of bleeding out has happened. But from a human capital perspective, I think along with that, you've seen some of the smarter folks in the fund of fund world, as the AUM has contracted, find spots at end institutions. From a hedge fund manager or investment manager's perspective, the nice thing about an institutional investor is ultimately it's their capital and they're controlling the decision. Whereas you might have a fund of fund client and they're great investors, you have a great relationship, but if they're getting redeemed massively, they need the money, that's going to flow through to you. Whereas if it's with an end institution, if everything's going well and you're performing in line with the expectations, there doesn't necessarily need to be a catalyst for them to reduce exposure.
Yeah. So what about performance? 2018 has been a crazy year where we saw February had a big sell-off in the U.S. markets, but as I just mentioned, we're literally right now at all-time highs in the U.S. equity markets. But at the same time, there's been a lot of differentiation because emerging markets are having a lot of trouble. Commodity markets have declined. What do you get the sense on general performance?
Performance is always a mixed bag. I think the knock on hedge funds, certainly since the market run began in March of 2009, is that performance hasn't been great for hedge funds. And I think the proxy for that always tends to be long short equity funds. But lost in that is an important note that the word hedge is in there. And that while hedge funds want to beat the market and outperform, if they're running a hedged book, it's tough to do that. And so what that leaves managers doing is either have to take more risk or lever up. I think that, we're starting to finally see sentiment, at least towards long short equity, change. And that's for the exact reason you just said, which is that we're at all-time highs. I think last week we entered the longest bull market run in U.S. equities. So no one's got a crystal ball, but it certainly feels closer to the end of the game than the beginning of it. And people are starting to take some profits and take risk off. They're going to stay allocated, but I think incremental new dollars are going towards more market neutral strategies, more uncorrelated strategies. And generally speaking, allocators are not adding incremental beta to their portfolios, which makes sense.
Yeah. Well, continuing on what you were just saying there, moving away from the performance side, where's the fund flow going right now? Are people still excited about equities? Is it commodities? Is it fixed income? A mix? Macro? Is it less liquid things like real estate? What's your thoughts there?
Yes. So again, I think now we have to kind of go back to where we started with conduits, and people are often saying, what are institutional investors doing? And there really isn't necessarily an overarching theme. I think if you penetrate a little deeper and you say, what are endowments and foundations doing? That's a little easier. So let's start there. I think typically endowments and foundations are longer duration money. So they're willing to take a longer scope. They're willing to take volatility, and they're willing to be more illiquid than most other asset classes, most other institutional investors. So increasingly in conversations with endowment foundations, I'm seeing very little appetite for increased exposure to long short equity in the U.S. Certainly, I think in a large or mega cap. So where there is interest, it's with specialists, either sector specialists or managers who are down market cap. I think institutional investors increasingly want to see concentration. They want to see people with higher conviction and fewer bets. I think the endowment and foundation world is increasingly continued to look offshore. And I think there's a lot of appetite for Asia and emerging markets. Now, to be fair, some of that is lip service, and that's where they're spending a lot of time looking. I don't know how much they're pulling the trigger, but again, if you're long duration capital, they're probably less worried about an entry point on a month-to-month basis, and they're more focused on, where do we want to be, where do we want to increase exposure over the coming years. If we shift a little bit to pensions, particularly in the corporate world, I think there is increasing demand for low beta strategies. And so equities are probably less, long short equity is probably less prevalent there. There's a lot of appetite for fixed income, relative value fixed income, currency volatility strategies. But, pensions are much more conservative. They do have obligations, and those obligations are more interest rate sensitive. They're more idiosyncratic sensitive to what may be going on in the company or with the pensioners. So they're less likely to take on risk, and they're looking for things that are uncorrelated and in some cases almost more like bond proxies. And then, the sovereign wealth fund is the last bucket worth mentioning. The challenge with some of the sovereign funds is that the larger sovereign wealth funds have to write very large tickets for it to be worth their time. And so in the parlance of a trader, having a 0.25% position, even if you think it's an interesting company, it doesn't move the needle for you. So they have to put money to work in big ways, and they're not going to write a $500 million check to a $400 million fund. And so when you see a lot of the commentary about big funds getting a big chunk of the flow, a lot of that is because, groups that have to write several $100 million checks, they don't have a lot of options. So I think, in summary, hopefully, Mike, you're seeing that the institutional market, it varies by conduit, and we haven't even really delved in too much to the geography, but it's nuanced.
Well, I'm starting to get a few questions in, but I wanted to ask one more before on a kind of follow-up side. So what's kind of a crazier sort of investment idea that you've seen kind of more people piling into over the past year that's more out of the box, not in the market, not like equity style related? Like, was it agriculture or some sort of, any in a different part of the world or anything of that nature?
Well, let me answer it two ways. Let me answer it in one, where I've been seeing money crowding into, and two, crazier ideas, because they're somewhat different. So there has been a lot of money flowing into private credit strategies really over the last 3 or 4 years. And if you think about where that capital is coming from, a lot of it is institutional capital. A lot of it is pension type of capital. And the reason is it's becoming so a lot of the models around what they've had to pay pensioners were written 10, 15, 20 years ago when interest rates and spend rates were very different. Well, in the current environment, they sort of have two options. They can lower their return expectations, or they can take more or different risk. And lowering the return expectations when it's not your money means that some pensioner's check is getting come. And politically, that's a very tough decision to make, especially if you're effectively just an employee at a pension plan. So what that means is that they're taking more risk. And one of the ways they're taking more risk is longer duration or less liquidity. So the private credit bucket has grown pretty fast over the last few years. It's been clustered the most in firms that lend to PE-backed lower middle market companies. Interestingly enough, one of the larger consultants, Willis Towers Watson, that was one of the earlier ones to sort of bang the drum on this. They wrote a paper in 2015, sort of promoting it as an asset class. 2 weeks ago, put out a paper which they hadn't done in a while, urging caution because so much money has been raised. Anecdotally, I was talking to an investment banker last week, and he said that companies they don't really even have to try to get private credit. That there are all these private credit funds because so much capital has been raised that are throwing credit at them. I'm not a market prognosticator, but I am a contrarian, and I think this probably ends poorly. There are niches within private credit that remain really interesting. We're working with the fund right now that has a very particular focus, and I think there's always appetite for different. So that's answer to part one of where have there been big capital flows. The other part of your question, which you said is what are the craziest things? You know, I don't think anything is that crazy on balance, but I think there's definitely a proliferation of nichier ideas. We're starting to see buckets form just for alternatives. That includes things certainly like agriculture, litigation finance, royalty lending. And even within agriculture, there's always been timber strategies. I think I mentioned to you before this conversation began offline that we saw a group out there raising an almond fund, and they raised a pretty good chunk of money from some pretty savvy Ivy League endowment types of firms. There are always zany ideas that aren't necessarily viable. I did see a deck come through a couple of months ago on an insect protein fund.
Everybody's looking for protein.
Everyone's looking. Look, there's actually a decent.
I remember you told me about that almond one a few months ago. That was an interesting kind of area.
And then I think the buzz, which is out there, and I haven't seen it really adopted yet institutionally, is of course around cryptocurrency and blockchain. It's just not somewhere that I think an institution is going to stick their neck out quite yet. But maybe people are getting up the learning curve a little bit on it.
Well, that's interesting, actually. So following up on that, do you get the sense that there has been much sizable investment in that space? And do you think that now that the market has come back at pretty good chunk, that people are gearing up to maybe invest in that space, or just no interest?
I know enough to know when I don't know something. And I've tried really hard to understand crypto and blockchain. I think I've got sort of the basics of it, but I haven't dug in deep enough to really understand it myself. And frankly, as a function of that, I haven't spent a lot of time talking to investors about it. The one thing I will tell you is that I do know a couple of people that I respect a lot, that I think are really smart people that are building or running crypto funds. And I've asked them what the market appetite has been like. It's been almost exclusively high net worth and family offices that have ended up pulling the trigger. And I think the challenge for some of these managers has been that they're starting to have some institutions come and have conversations, but ultimately they're just there to kind of get an education and get up to speed. And,
right.
As a fund manager, look, your job is ultimately to invest. And second to that, to service your existing and cultivate relationships with potential clients, but they're not necessarily there just to give a free education. So I don't think we're there yet. I don't think it's just driven by market sentiment. I think it's sort of more about the institutionalization and the structure of it. The other place where we haven't seen institutional appetite yet, but I think will come, is in the cannabis industry. It's another area that I've spent a little bit of time looking at. I think the institutions won't be there until the regulatory environment changes and they have a little more cover for pulling the trigger on it. But I think people are starting to do a little work there. And the last area, which I should mention, and again, I haven't spent a whole lot of time on it, is on impact investing, whether it's socially responsible investing, environmentally friendly. We've done a little bit of work on a solar infrastructure fund, but those buckets are getting bigger and bigger for impact investing.
Yeah, that's interesting. So there are a few questions here. Let me jump and ask you. And I guess this one here, and a lot of our subscribers are on, discretionary traders or independent traders. And so somebody's asking here, if I start a smaller fund, where should I look to raise assets?
Oof. If you start a smaller fund, my answer is think long and hard about it. However much money you think you're going to raise half as much, and it's going to take you 4 times as long. So I'll qualify it by that. Look, I think that the environment for a new fund launch is tough. If you want to do it institutionally, you really, whether it's fair or not, the pedigree matters, where you came out of, and even your track record. It has to be referenceable. So if you're coming out of a shop where you own your track record, that helps dramatically. If I firmly believe some of the best traders in the world are trading PA or are trading small pools of capital. It's a really tough road to make the jump from that, no matter how good your track record is, to being a fund manager and being a fiduciary. If you're intent on doing it, my suggestion is to cobble together dollars from whether it's friends and family or high net worth in your circle, or one derivative from that where they're investing with you because they know you, they like you, they trust you more than necessarily in your strategy. And put your head down. Put your head down for a year, and sort of prove your merit as a fiduciary. Put up the numbers you need to, and then gradually start your outreach. Unless you're launching with an inordinate amount of money, there's sort of a natural progression of it's going to start with high net worth. It's going to move into family offices. The endowments and foundations are one of the more enjoyable relationships that I like building, because when you get them, they're really sticky. They're really good partners, but they tend to take a really long time to get to know someone and invest. So,
And when you say long time, just give us a ballpark.
for endowments and foundations, I think it's measured in years.
Right. Maybe like
I mean,
it could be two, three
if you
years from the
if you
first time you meet
launch
them.
a fund, if you launch a fund, and again, I'm not including the $2 billion launch by a guy who was a rock star at a brand name fund, but for most people starting, if you're starting with 50, 75, 100 million, if your first conversation is with an endowment after you launch, I think you should expect at least 2 years before you see the fruits of that. And the pension and the sovereign wealth stuff is going to be, they're not even going to look at you. Where the endowments and foundations may have that conversation day one, the pensions probably won't even have the conversation begin until you're 2 years in and you're at, call it $250 million.
Well, that gets me back to the beginning part. Let's, take it back, because you were talking about friends and family, this and that. Like, how much do you think somebody needs to scrape together to kind of be able to go out to smaller players to build up, to kind of then go out to larger players that you might be talking about?
It's a good question, Mike. And part of the calculus that comes into play is the cost of running this business. And a portfolio manager or trader really has to think about it as a business. The costs of running it are a lot higher. It's not just two guys in a Bloomberg screen. You have regulatory costs, you have compliance costs, you have back office costs, you have fund administration, audit, et cetera. So, I think you have to think about the break even. And if you launch with 25 million, and you're partnering with good service providers, but not necessarily even top tier, you may not be breaking even at 25 million. So the answer is different for everyone. Are you willing to subsidize this yourself until you get to that point? But I think, really 50 million is a number that you're kind of in the game, and you've got a chance. Let me give you a different data point. This is a real-time data. I was in New York earlier this week, and I met with one of the prime brokerage groups at one of the top 3 investment banks, and I was asking him about the environment for new fund launches. And these are numbers that he shared with me. So he said last year they launched 42 new funds as prime brokerage clients. And they try to be selective and only take on, clients that they think have the ability to grow and be revenue generators for the bank. Of those 42, about 80% of them were long short equity funds because the barrier to starting is the lowest, the cost of starting is the lowest. And every bank has a slightly different model. What this bank prime broker said is, if we accept a manager onto the prime brokerage platform, we give them 18 months. And for that 18 months, we treat them, if they have 100 million, we treat them like they're a $1 billion client. And they can get corporate access, they can get research, they can get everything they need. At the end of 18 months, we reevaluate the relationship. And so of the 42 million that launched, the average launch size was 150 million. And that was skewed by two very big launches that were measured in the billions. So let's assume
that seems high.
It includes two very big ones. But again, I mean, this is a top tier bank. They're focused on the sort of more institutional launches. But let's assume that the real median number is 100 million. What he told me is the reason that 18%, that 18-month number is magical, and they've back tested this through decades, is that after 18 months, the current trajectory is that 50% of those funds are out of business. 8% of them are north of $1 billion. And so the remaining amount are in that sort of 100 million to $1 billion. I didn't ask for the granularity of it, but my guess is they're closer to the 100 million. And at $100 million, it's a nice business, but that's probably enough to support a full-time CFO, a full-time analyst, and maybe one other light ops or admin person. But it's a tough business. It's a tough environment.
Yeah.
So I don't know if that helps.
Yeah, very good, very good. So I got two more questions for you. One is on that, because you're talking about fees, this and that. What have fees done? Like, where are fees these days? Where were they 10 years ago, and what are fees now?
Good question. So 2 and 20 is dead and done and long gone. I think even the firms that their headline is 2 and 20, there are very, very few firms, like I would guess you can count them on one hand, that are charging that and getting it. So even if the headline fee is 2 and 20, they're not getting it. I think the bogey for an established manager, and I'm talking about a firm that's $1 billion, that's been around 5 years, the bogey is probably 1.5 and 20. What you do see is sort of founders' fees, excluding seeders, but kind of people that, if you have a $50 million seed, the next 50 million you're going to get, call it 1 in 10 or 1.25 and 12.5. So that's kind of the broad fee paradigm. What I would say is, hearkening back a little bit to what I said about the sophistication ramp for institutional investors, the big investors that are very savvy can dictate what they're willing to pay. And so what that means is increasingly they want alignment, and they're willing to pay more for alpha, but not for anything else. I'll give you one small example. There's a corporate pension fund in the West Coast that's about a $20 billion plan. And they've been going through this exercise for the last 3 or 4 years, where they've been going to long short equity hedge fund managers. And they've been going to managers that have pretty decent AUM. I think their minimum threshold is about 500 million, and that have long enough track record, so 5 years plus. And they've been talking to them about running a separate account in a long only mandate. And basically what they said is they're willing to trade size and duration for fees. So the sort of starting point is, we're willing to start with 200 million. It could grow to 400 million. And we're willing to pay you roughly a third of the alpha. And so what that means in a long only world is as the pension fund, I'm proposing I pay you 0% management fee and 33% incentive fee on any return you get above an appropriate benchmark. There's a little wiggle room there. You might be able to get 25 basis points of management fee for 25% above. And again, that's specific to one investor, but those are the types of conversations that are being had. I think managers have to make a decision if they have capacity. Do they want to fill it by long-term sticky money and put their head down and invest? And are they willing to give up some economics for it? One last thing, and this dovetails back into the question the prior gentleman asked about, launching a new fund. I think a lot of traders or portfolio managers, the calculus they're going through is exactly the one we've just done, which is, okay, if I get 25 million or 50 or even 100, what does it cost? And some of these groups are saying, you know what, is it worth it to me? And the option that is out there is joining one of the bigger platforms, whether it's Millennium, Balyasny, Citadel, Point 72, where you're saying, look, all I have to do is focus on the screen, is focus on trading and making money. And I don't have to worry about marketing. I don't have to worry about compliance. I don't have to worry about audits or boards of directors. And I can just run money. And, there's a dollar amount to that peace of mind, and the dollar amount's different for everyone, but it's something to think about.
Yeah, that's interesting. All right, last question here. Somebody's asking, is money still interested in discretionary guys or all systematic? What are your thoughts there?
I think there's definite interest in discretionary. So, and maybe this is a trend that we glossed over, but prior to this year, there was a lot of money flowing into quant. I sense that has calmed down a little bit. I think quant, again, this is generally speaking, has underperformed expectations a little bit. I think there's always appetite for discretion, but you have to be able to articulate what that discretion is. And the question that every allocator, every investor asks a fund manager in the first meeting, and it drives the managers crazy, is what's your edge, right? If your edge is just, I'm a guy who looks at screens and I'm a money maker and my track record shows that, candidly, that's tough. It's going to be tough for someone institutionally to take that leap of faith. If you're a discretionary trader and you say, look, I'm a discretionary trader, but I focus on transportation stocks, and I focus on transportation stocks, up and down the market cap, and I'm focused just on the U.S. And the reason I do that is because, I was an investment banker, I was an analyst in that space, or I was an operator for a trucking company, and I get this type of data in real time, and I talk to truckers, and I synthesize all of that, and I know this space better than anyone else, and I use discretion to buy and sell based on who I think are going to be winners and losers in that space in the near, long term, where it's catalyst driven. There's absolutely an appetite, but the importance is having an edge and being able to articulate it.
Yeah, it's really interesting. And, that word edge, that's what, Mark Fisher talks about, Larry talks about. A lot of people, you got to be able to say what your edge is in the market. Matt, a lot of great information. I really appreciate you sitting down and talking with us. Tons of information. He's been around for a long time, raised assets for a lot of different funds and vehicles, and so he has a lot of great information. Thanks a lot, Matt. So Matt Aptman of Everglades Partners. Talk to you soon, Matt.
My pleasure. Thanks for having me, Mike.